Imagine holding a corporate bond for 10 years. You bought it a decade ago, you tucked it away in your portfolio, and you've been, patiently watching it compound.
Right. A classic long-term play.
Exactly. So you're thinking you've built this safe, tax-efficient retirement nest egg. And you finally go to sell it, expecting to be rewarded for your long-term patience with a nice, low, long-term capital gains tax rate.
Let me guess. It didn't quite work out that way.
No, not at all. Only to find out, right at the finish line, that because of one missing word on the bond's original prospectus, a detail you completely ignored, by the way, your tax bill hasn't just gone up a little bit.
It doubled.
It literally doubled. You are getting taxed at the absolute highest, most punishing short-term slab rate, all because of a technicality.
And that is exactly the kind of nightmare scenario that plays out in the real world every day. And it's exactly what the test makers are going to use to trap you.
Yeah.
When you are dealing with the taxation of debt products, common sense is often your worst enemy.
Seriously. Well, welcome to the deep dive, everyone. If you're listening to this, you are probably staring down the barrel of the NISM Series XB certification exam.
Specifically, the notoriously brutal taxation module.
Right. I am your host, and think of me as the dedicated student sitting right next to you. I'm the third person in this study group. I've been trying to decode the official study materials, and frankly, it feels like the rules change every 3 pages.
They practically do.
So I brought in the heavy artillery. Sitting across from me is my lead financial educator and mentor. Your goal today is to help me and you, the listener, build a mental fortress around these concepts so we just don't fall into these regulatory sinkholes.
I am ready. And, you're right to be cautious. This specific area of financial regulation is a legislative minefield.
Good minefield, yeah.
One wrong assumption about how long you held an asset or whether it's listed versus unlisted, and your entire calculation is wrong.
And for an investor, that means losing money.
Exactly. And for a certification candidate, that means failing the exam. So today, we're taking a completely uncompromising approach.
No skimming.
No skimming, and we're certainly not summarizing. If there are 7 rules to a category, we are going to tear apart all 7. By the end of the session, you will not need to look at that PDF again.
That is exactly what I want to hear. Let's start at the absolute bedrock. Before we get into holding periods and complex formulas, we need to understand how the government actually views the money we make from debt products.
Because it doesn't all go into one bucket.
Right. So what are the buckets?
Well, you have to physically separate your returns into 2 distinct, non-overlapping buckets. If you get this wrong, nothing else matters. Bucket number 1 is your periodic income.
So interest.
Yes,
Yeah.
This is the interest. It is the money you are paid simply as a reward for holding the instrument over time.
Okay, got it.
Bucket number 2 is completely different. This is the gain or the loss that happens when you actually transfer the security, meaning you sell it to someone else on the secondary market, or when you redeem it.
Like when it matures and the issuer gives you your principal back.
Exactly. The second bucket is strictly classified as capital gains.
Okay, let's unpack bucket 1 first. Interest income. The rule book says that interest on securities is taxable under the head income from other sources.
Yes, unless, of course, you are trading bonds for a living.
Right, in which case it's business income.
Yeah.
That feels pretty intuitive. But then, almost immediately, the regulations throw a massive curveball regarding how you account for that interest.
Yes, and this is where you need to be wide awake. Flag this for the exam. Section 145 of the Income Tax Act governs the accounting method.
Section 145, okay.
And the law mandates that you cannot just guess. You must compute your income based on the method of accounting that you, the taxpayer, regularly employ. And you only get 2 choices.
Which are?
The mercantile system or the cash system.
Okay, let's translate this because I know people get tangled in the accounting jargon. The mercantile system is essentially an accrual basis, right?
Yeah.
Let me try an analogy here to see if I have this right. It is exactly like my postpaid mobile bill.
Okay, walk me through it.
If my billing cycle ends on the 31st of the month, my telecom provider generates a bill. They say I owe them that money for that month's usage.
Right.
On their books, they recognize that revenue immediately, even though I haven't actually paid the bill yet, and that cash hasn't hit their bank account. They tax it when it's earned, not when it's paid.
That is a flawless analogy. Under the mercantile system, if interest accrues to you during a specific financial year, you owe tax on that interest for that specific year. Period.
Wow.
It does not matter if the cash is delayed or if the payout date is scheduled for 3 months into the next financial year. If it accrued, you declare it.
Which honestly sounds incredibly painful. because it means I could owe taxes to the government on money I haven't even received yet.
You are.
I'm effectively having to use other cash to pay a tax bill on phantom income.
That is the reality for many investors and almost all corporations. Now, contrast that with the cash system.
Much simpler, I assume.
Blissfully simple. It is entirely receipt-based. You only recognize the income, and therefore you only owe the tax when the actual rupees land in your hands or clear your bank account.
Okay, let's ground this in a real-world example.
Huh.
Let's say I go to my local bank and open a traditional 5-year cumulative fixed deposit.
Sure.
It pays out absolutely nothing until the very end of year 5. But every single year, the bank sends me a TDS certificate showing that interest is building up.
Right, it's accruing.
So if I'm strictly following the mercantile system, I have to declare that accrued interest on my tax return every single year, right? Even though my bank account balance hasn't moved a single rupee.
Precisely. You are paying tax out of pocket year after year.
And under the cash system.
If you followed the cash system, you would just ignore it for 4 years and then declare one massive lump sum of interest in year 5 when the FD actually matures.
Well, then why would anyone ever choose the mercantile system? I just choose the cash system so I don't have to pay until I get paid.
Because you don't get to pick and choose based on convenience.
Oh.
The law states it must be the method of accounting regularly employed. If you run a business or you have complex investments, you are almost certainly already using the mercantile system for everything else.
Ah, I see.
You cannot suddenly flip to the cash system just for your bond interest to delay your tax bill. Consistency is legally required.
Got it. Consistency. Now, before we move to capital gains, there's a small trapdoor I noticed regarding tax-free income.
Ah, you are referring to Section 10 of the Income Tax Act.
Right.
This is the magic shield. If an instrument is explicitly notified under Section 10, like certain infrastructure bonds, the interest income simply vanishes from the tax net. It is completely exempt.
Nice.
But we will dive much deeper into the mechanics of tax-free bonds a little later because there is a massive misconception about what tax-free actually means.
Okay, consider me warned. Let's pivot to bucket 2. Capital gains. We said a capital gain happens when you sell or redeem a security. The regulations are very specific that the security must be held as an investment or a capital asset. But there is a huge blanket exception carved out right at the beginning for a specific type of investor.
Yes. Flag this for the exam. The regulations explicitly state securities held by foreign portfolio investors, or FPIs, are always treated as a capital asset. No exceptions.
Always.
Always. Therefore, any income an FPI makes from buying and selling securities is strictly taxed under the head of capital gains, never as business income.
But why? Why do they get a special blanket rule? If I, as a resident retail investor, sit at my computer and day trade bonds all week, the tax department is absolutely going to classify that as business income and tax me at my slab rate.
Oh, without a doubt.
So why do massive foreign institutions get a free pass straight to capital gains?
It is not a free pass. It is a logistical necessity. Think about the scale here. FPIs execute millions of algorithmic trades across global markets.
Yeah, that's true.
They might hold a government bond for 2 years and then flip a corporate bond in 2 minutes. If the Indian tax authorities had to look at every single one of those millions of trades and argue intent.
Oh, like saying, well, this one looks like a long-term investment, but this one looks like a business trade.
Exactly. It would cause a complete administrative breakdown. It would lead to endless litigation. So the government created a legal fiction to provide absolute certainty to foreign capital. For FPIs, securities are always capital assets. It removes the ambiguity entirely.
Makes sense for them. But for us, mere mortals, the resident investors.
For you, there is no blanket rule. Your tax fate depends on a complex matrix. What exact type of security is it? Exactly how long did you hold it? And is it listed on an exchange or not?
Which brings us to the real meat of the matter. Let's decode standard coupon bonds. The materials give us a very specific nomenclature to look at. It says a 7.4% CG bond 2027.
Right.
Walk me through the anatomy of this instrument.
Every piece of that name is critical data. Bonds are generally issued at a face value, say rupees 100 or 1,000. The 7.4% is your coupon rate.
The interest.
Exactly. Mathematically, you are guaranteed 7.4% of that face value in interest every single year.
Okay, and the CG part.
The CG tells you who owes you the money, in this case, the central government. That establishes your risk profile, which here is practically zero default risk. Finally, 2027 is your maturity. That is the year the government will hand back your original principal.
Now, there is a concept mentioned right alongside this called yield to maturity, or YTM. I know this isn't a direct line item on my tax return, but it seems foundational to understanding how bonds actually trade.
It is completely foundational. Let's say that 7.4% bond has a face value of rupees 100. So it pays 7.4 rupees every year.
Right.
That coupon is fixed, it never changes. But the market value of that bond is constantly moving up and down based on what the Reserve Bank of India is doing with broader interest rates.
So the price fluctuates.
Yes, if you buy that bond in the secondary market today, you might have to pay a premium. You might pay rupees 105 for it.
Right, because 7.4% might look really attractive compared to what new bonds are offering today.
Exactly. But if you pay 105 today and the government is only going to give you 100 back in 2027, you are going to take a 5 rupee capital loss at maturity.
Oh, right.
So your true annualized return isn't 7.4%. It's going to be lower because that upfront premium eats into your profits.
And that's what YTM is.
Exactly. Yield to maturity calculates exactly that. It is the single interest rate that equates the present value of all those future payments plus the final principal to the price you paid today. It is your true actualized return if you hold the bond to the very end.
Okay, let's talk about taxing that coupon payment. The rules say it's taxable at your normal slab rates. But I see a provision here for deductions. It says, I can deduct expenses wholly and exclusively incurred to earn that interest. What does that actually mean in practice?
It's meant for direct, unavoidable costs. For instance, if you have a massive portfolio of physical bonds and you pay a bank or a collection agent a specific commission fee purely to process and realize those interest warrants.
Oh, like a handling fee.
Right. The government allows you to subtract that fee from your interest income before you calculate your tax. You only pay tax on the net interest you actually keep.
That seems fair. But then the very next paragraph drops a hammer. It says, if the interest is being taxed at a special concessional rate, then absolutely no deductions are allowed.
None.
And it specifically calls out Chapter VIA deductions, which includes the famous Section 80C. Wait, can I claim Section 80C deductions against this specific interest if it's taxed at a concessional rate?
Absolutely not, and you must pay attention to that. Let's look at the government's logic. Under Section 80C, the government allows you to deduct up to 1.5 lakhs from your total income for things like life insurance or PPF.
Right, to lower my tax burden.
Yes. But those deductions are designed to offset your regular income that is being punished at the highest 30% slab rates. If the government has already given you a sweet deal, a concessional flat tax rate of, say, 10% or 15% on a specific type of bond interest, they are drawing a line in the sand.
Ah, I see.
They are saying, we already gave you a discount. You cannot double dip and use your ADC life insurance premium to wipe out this low tax income too.
No double dipping.
Ugh.
Okay, I think we need to put some real numbers to the mercantile versus cash system we talked about earlier, because seeing the math changes everything. Let's walk through the textbook's first scenario, but let's make it a story.
Let's do it. Visualize a two-column ledger. Picture this scenario. We have an investor, Mr. A. He lives in India. On New Year's Day, January 1st, 2024, he decides to buy corporate bonds. He buys 1,000 bonds of an Indian company. Each bond has a face value of rupees 100, so he's deploying exactly rupees 1 lakh of capital. The company promises a coupon rate of 7.50% per annum.
Maturing when?
The maturity is 5 years away, ending December 2029.
Okay, 1 lakh invested at 7.5%. That means he is owed 7,500 rupees every single year in interest.
Correct. But here is the critical mechanical detail that changes the tax math. The company doesn't pay the interest once a year. They pay it half yearly.
Okay.
Specifically, on June 30th and December 31st of every year, so that 7,500 annual interest is chopped in half. He receives 3,750 on June 30th and another 3,750 on December 31st.
Got it. Now, the exam is going to ask us to compute his taxable interest specifically for the financial year 2024 to 2025.
First step, we must define the boundaries of that financial year. In India, the financial year 2024 to 25 starts on April 1st, 2024, and ends exactly on March 31st, 2025. Everything outside those dates is irrelevant for this specific tax return.
Right. Let's look at this through the lens of the mercantile system first. The system where we have to track every day the interest builds up, regardless of when he gets paid.
Let's look at the timeline. He bought the bonds on John 1st, 2024. The financial year starts April 1st. From John 1st to March 31st, 3 months pass.
Right.
During those 3 months, the bond is ticking away, earning interest, half of a half-yearly payment. So 1,875 rupees of interest has accrued.
Okay.
Because Mr. A follows the mercantile system, that 1,875 is legally taxable in the previous financial year, 2023 to 24, even though June 30th hasn't happened yet, and he has zero cash in his hand.
Okay, so that piece is out of the way. Now we cross into our target year starting April 1st, 2024.
Exactly. From April 1st to June 30th, another 3 months pass. The bond accrues another 1,875 rupees. This falls inside our target year, so that amount is added to his 2024-25 tax bill. Then, on June 30th, the company finally sends him a check for the full 3,750.
But wait, he doesn't get taxed on the whole 3,750 right now, right? Because under the mercantile system, he already paid taxes on half of it back in March.
Exactly. That is the beauty and the curse of the mercantile system. You chop up the cash flow strictly by the calendar days. So for the first quarter of our financial year, he adds just 1,875 to his taxable income.
What happens in the next 6 months, from July 1st to December 31st?
This is the easy part. Those full 6 months fall entirely inside our target financial year. 6 months of interest accrue, which is 3,750. And on December 31st, he actually receives it. So we add another 3,750 to his taxable income.
Now we have the final stretch of the financial year, January 1st, 2025 to March 31st, 2025.
History repeats itself. 3 months pass. The bond accrues another 1,875. He won't see the cash until June, but because it's the mercantile system, he must declare that 1,875 on his current tax return.
So if I sum up the mercantile tax bill for the year, he pays tax on 1,875 for the April-June accrual, plus 3,750 for the July-December accrual, plus 1,875 for the Jan-March accrual. Total taxable interest is 7,500.
Perfect. Now, wipe the slate clean. Let's look at the exact same investor, exact same dates, exact same bonds, but this time he uses the cash system.
This should be much simpler. We only care about when the rupees hit the bank account between April 1st and March 31st.
Exactly. Let's look at the timeline again. Jan to March 2024. He bought the bonds, they are accruing interest, but does he receive any cash? No. So his taxable income for that previous year is zero.
We enter the target financial year, April 1st. On June 30th, he gets his first payment of 3,750.
Under the cash system, he received the cash during the financial year. So, boom, 3,750 is immediately taxable. He doesn't care that half of it accrued in the previous year. He got the cash today, he pays the tax today.
Then on December 31st, he gets his second payment.
Same logic. He received cash. It's taxable. Boom, another 3,750.
And from Jan 1st to March 31st, 2025.
He receives zero cash, so he owes zero tax for that quarter.
So under the cash system, his total taxable income for the year is the June payment plus the December payment. The total is 7,500.
Do you see what just happened? The total taxable amount for the year, 7,500, is exactly the same under both systems.
Yeah, the math lands in the same place.
But the path to get there is entirely different. The mercantile system forces you to track phantom income across financial year boundaries. The cash system only tracks actual bank deposits. If the exam gives you an irregular purchase date and a weird coupon payment schedule, you have to read the question carefully to see which system the assessee follows.
Because the numbers in the first year will look totally different.
Exactly. Okay, we've mastered bucket 1. Let's talk about bucket 2. Capital gains on bonds. This is the part of the rule book where things stop being logical and start being incredibly punitive. The materials give us a massive table. Table 10.1. Let's break this down without taking any shortcuts.
Okay, so this table dictates how your holding period determines your tax rate.
Yes, and the rules are fundamentally completely different depending on a single variable. Flag this for the exam. Holding periods dictate your tax rate, and it all hinges on whether the bond is listed on a recognized stock exchange or if it is unlisted. Let's take category 1, listed bonds and debentures.
Okay, so these are bonds I can buy and sell easily through my broker, like a normal stock.
Correct. The government likes listed bonds because they are transparent. They are traded openly, so they give you a relatively generous holding period. To qualify as a long-term capital asset, you only need to hold a listed bond for more than 12 months, just 1 year and 1 day.
And what is the prize for holding it for 12 months?
A massively reduced tax rate. If you sell it after 12 months, your long-term capital gain is taxed at a flat 12.50%. And this is a critical exam trap. This is strictly without any indexation benefit.
No inflation adjustment.
None. You cannot adjust your original purchase price upward to account for inflation over those years. It is a flat 12.5% on the absolute numerical profit.
Okay, and if I panic and sell that listed bond after just 6 months?
Then you failed to cross the 12-month finish line. It is a short-term capital gain, and there is no special rate for that. The profit is simply added to your total income and taxed at your normal applicable slab rate.
Which could be 30% or more.
Exactly.
That seems like a standard risk-reward setup. Now let's look at Category 2, unlisted bonds and unlisted debentures.
And this is where the bouncer at the door completely changes the dress code. For unlisted bonds, the holding period required to qualify for that sweet long-term 12.5% rate is not applicable.
Wait, what do you mean not applicable? If I buy an unlisted corporate bond directly from a company in a private placement, and I hold that bond for 10 years through thick and thin, and then I finally sell it or it matures, you are saying it's still considered short-term.
I am saying exactly that. It is always short-term. It doesn't matter if you held it for 10 years or 10 days. The capital gains arising from unlisted bonds are always treated as short-term capital gains.
Always.
Always. Therefore, the entire 10 years of profit will be added to your income in the year you sell it, and it will be taxed at your normal maximum slab rate.
Hold on. If I hold an unlisted bond for 10 years, it's still short-term. That completely changes the risk-reward math. Why would the government do that? Unlisted bonds are inherently riskier and less liquid than listed ones. Why would any rational investor buy an unlisted bond if they know the government is going to confiscate 30% of their gains no matter how long they hold it?
You have just stumbled upon the exact policy intent of the Indian government. The government doesn't want you in unlisted bonds. Unlisted markets are opaque. Price discovery is terrible. It is harder for the regulators to monitor systemic risk.
So they're discouraging it.
Yes. They aren't just raising revenue here. They are actively using the tax code as a weapon to engineer investor behavior. They are intentionally making unlisted bonds so incredibly tax inefficient that retail investors are practically forced to abandon them and move their capital into the transparent listed markets where the regulators can see everything.
That is fascinating. Okay, let's see the actual mechanics of calculating this capital gain. The formula looks like basic arithmetic, but I want to make sure I'm not missing any hidden deductions.
The calculation format is rigid. You start with the full value of consideration. That simply means the gross amount of money you received when you sold it, or the final maturity amount you received from the issuer. From that top line number, you are allowed to subtract 3 very specific things.
Number 1 has to be what I paid for it.
Yes, cost of acquisition, the actual price you paid to buy the bond. Number 2, expenditure incurred wholly and exclusively in connection with the transfer. This is your frictional cost.
Like broker fees.
Exactly. If you had to pay a broker a commission to execute the sale, you subtract that fee so you aren't taxed on money you gave to the broker.
And what is the third deduction? It lists exemption under sections 54E to 54F.
These are specialized rollover exemptions. Basically, the government says if you make a huge capital gain, but you immediately take that profit and reinvest it into very specific things like funding a recognized startup under 54E or buying a residential house under 54F, we will let you avoid paying the capital gains tax entirely.
Yep.
But these are highly conditional. If you don't use those exemptions, the math is simple. Sale price minus purchase price minus brokerage fees equals your capital gain.
Let's run a scenario to see the massive difference between listed and unlisted in real life. Let's walk through another real-world scenario. Let's say an investor, Mr. A, buys 400 bonds of ABC Ltd on January 1st, 2016.
Yeah.
He pays rupees 1,200 for each bond. The actual face value is rupees 1,000, and they pay a 7% coupon half yearly. He holds them for years and finally sells them on July 31st, 2024 for rupees 2,000 each.
First, let's address the interest calculation for the year he sold them, 2024 to 25, assuming he uses the mercantile system. He sold on July 31st. The financial year started April 1st, so we have 4 months of interest to account for: April, May, June, and July.
Let's calculate the total annual interest. 400 bonds times the 1,000 rupee face value. Remember, we use the face value to calculate interest, not his purchase price of 1,200. So that is a 4 lakh rupee face value. 7% of that is 28,000 a year.
Let's break that down. Half yearly, he receives 14,000. Now, the official materials handle the month of July slightly differently in their simplified table, assuming the July accrual is handled in the transfer price. But the key takeaway for the exam is that you must isolate the interest that accrued from April 1st until the date he sold it and tax that under income from other sources. You cannot lump the accrued interest into the capital gain.
Okay, let's look at the actual capital gain, which is the massive chunk of money here. He bought on Jan 1st, 2016. He sold on July 31st, 2024. That is an enormous holding period of 8 years and 7 months.
Let's assume for scenario A that these bonds are strictly listed on a recognized stock exchange. Because they are listed, and his 8-year holding period is way past the 12-month threshold, this is a definitive long-term capital gain.
Let's do the math. Full value of consideration. 400 bonds sold at 2,000 each. That's 8 lakhs in his pocket. Less cost of acquisition. 400 bonds bought at 1,200 each. That's an initial investment of 4,80,000.
Right. 8 lakhs minus 4 lakhs 80,000 gives us a raw profit, a long-term capital gain of 3 lakhs 20,000. And what is his reward for holding a listed bond for 8 years? The government taxes that 3 lakhs 20,000 at a flat concessional rate of 12.50%, a very reasonable outcome.
Now let's look at scenario B. This is where the nightmare happens. It is the exact same investor. He bought on the exact same day in 2016. He paid the exact same 1,200 price. He sold on the exact same day in 2024 for 2,000. The math is identical. The profit is identical at 3 lakhs 20,000. The only difference.
The bond he bought was an unlisted corporate bond.
Yep.
And suddenly, that 8-year holding period is utterly meaningless. The bouncer changes the dress code. The rulebook says unlisted bonds are always short-term, irrespective of the period of holding. Therefore, that entire 3 lakhs 20,000 profit is ripped out of the capital gain schedule and dumped directly onto his normal income.
If he is a successful professional in the 30% tax bracket, his tax bill on that trade just leaped from roughly 40,000 under the listed scenario to nearly 1 lakh. He lost a massive chunk of his 8-year compounding return in a single day simply because the bond wasn't traded on a screen.
It's brutal.
That is the kind of regulatory sinkhole that destroys portfolios.
Which is why you must verify the listing status of every debt instrument you touch. Now let's add another layer of complexity. What happens if the investor isn't an Indian resident? The rulebook outlines very specific mechanics for non-resident Indians, or NRIs, in Table 10.3.
Okay, let's dissect Table 10.3. It's titled Long-Term Capital Gains Tax to NRIs.
For standard listed bonds, the rule is relatively simple. A non-resident pays the same 12.50% rate, and just like residents, they get no indexation benefit. But the exam is going to focus on 2 specific sections of the Income Tax Act that handle edge cases. Let's look at Section 115E first.
This section applies specifically to non-resident Indians.
Yes. It outlines a scenario where an NRI brings foreign currency, let's say US dollars, into India and uses it to purchase listed debentures of an Indian public company. Years later, they sell those debentures for a long-term capital gain. The tax rate is 12.50%. But here is your tripwire for the exam. The text explicitly states this 12.50% rate is calculated without indexation and foreign exchange fluctuation benefit.
We know what indexation is, but what exactly is the foreign exchange fluctuation benefit, and why does taking it away matter so much to an NRI?
Imagine you are an NRI. 10 years ago, you brought $10,000 to India. The exchange rate was 50 rupees to a dollar, so you invested 5 lakhs. You double your money over a decade. You now have 10 lakhs. You are thrilled.
Right.
You go to convert it back to dollars to take it home, but over that decade, the rupee depreciated. Now it takes 100 rupees to buy a single dollar. So your 10 lakhs only buys you $10,000.
Wow. You made a 100% return in rupees, but a 0% return in dollars. You made absolutely no real money.
Exactly. In certain asset classes, the Indian government recognizes this currency risk and allows NRIs to calculate their capital gains in their home currency in dollars. This protects them from paying taxes on phantom rupee profits that were wiped out by currency depreciation.
But for bonds?
For bonds under Section 115E, the government strips this protection away. You must calculate your profit purely in rupees, and you pay 12.50% on that rupee profit, even if you lost money in dollar terms. It is a massive hidden risk for foreign investors.
That's intense. And what about the other section mentioned in the table, Section 112(1)(c)(3)?
This acts as a catch-all for any non-resident. It covers long-term capital gains arising from unlisted securities, but explicitly excludes unlisted bonds and debentures from the benefit, because as we know, those are always short-term.
Right.
If it's another eligible unlisted security, the rate is 12.50%. And again, there is absolutely no indexation and no foreign exchange fluctuation benefit. If an exam question tries to offer an NRI indexation on a bond, you instantly know it's a trap. No indexation for listed bonds, period, regardless of where you live.
Let's do one more quick bond example to highlight a very common pricing trap in the secondary market. Let's walk through a scenario.
Our investor, Mr. A, goes into the market on April 1st, 2024, and buys a 9% listed bond. The actual face value is rupees 10,000, but he pays 10,500 for it. The bond pays interest quarterly. He holds it through the summer, receiving interest payments for the June and September quarters. Then, on November 1st, 2024, he decides to sell it. He sells it for 13,000. But the contract notes something very specific. The 13,000 is inclusive of interest accrued till the date of transfer.
This is the classic dirty price versus clean price dilemma. Let's break out the interest first. The bond pays 9% on a 10,000 rupee face value. That is 900 a year. Since it pays quarterly, that's 225 every 3 months. He held it for the June quarter 225 and the September quarter 225.
But he sold it on November 1st. That means he held it for exactly 1 month, the entire month of October since the last payment.
Right, so interest was silently ticking up during October. If a full year is 900, 1 month is 75. So for the financial year, his taxable interest income is 225 plus 225, plus that 75 of accrued October interest. Total taxable interest, 525.
Now let's calculate the capital gain. What is his holding period? He bought on April 1st and sold on November 1st.
That is exactly 7 months. It's a listed bond, but 7 months is way under the 12-month requirement. So this is short-term capital gain.
Correct. Now calculate his profit. The buyer handed him 13,000.
Wait, I can't just use 13,000 as my full value of consideration. The problem stated that price was inclusive of accrued interest.
Yes.
That 13,000 has the 75 rupees of October interest baked into it. The buyer was compensating Mr. A for that month of holding. If I calculate capital gains on the full 13,000, I will be paying capital gains tax on that 75, and I'm already paying income from other sources tax on it.
Okay.
I'd be taxed twice on the same 75 rupees.
Exactly. You must cleanse the sale price.
Yeah.
You take the dirty price of 13,000 and you strip out the 75 rupees of accrued interest. Your true adjusted sale consideration for capital gains purposes is 12,925.
From there, the math is easy. Adjusted sale price of 12,925 minus his original cost of acquisition, which was 10,500. He has a short-term capital gain of 2,425, and that will be taxed at his normal applicable slab rate.
If you see the phrase inclusive of interest accrued on the exam, alarms should be ringing in your head. You must separate the streams of income. Okay, that thoroughly covers corporate debt. Let's pivot to Section 3, the sovereign sanctuary, government securities.
Let's say I am an investor who has been burned by a corporate default. I am done taking credit risk. I want an ironclad guarantee that my principal will be returned. Where does the government direct me?
They direct you to government securities, or GSECs. The textbook refers to these as risk-free gilt-edged securities. They carry the absolute sovereign commitment for the payment of interest and the repayment of principal.
Right, because a government can always print its own currency to pay you back.
Exactly. So the default risk in local currency is 0.
The rulebook lists 4 distinct types of GSECs. Let's examine the mechanics of each one, starting with the shortest duration.
The first type is cash management bills, or CMBs. Think of these as the government's equivalent of a payday loan.
A payday loan.
Yeah. Tax revenues flow into the government unevenly throughout the year, but expenses are constant. When the government has a sudden temporary cash flow mismatch, they issue a CMB. They are highly flexible and issued for extremely short periods, strictly less than 91 days.
And how do they pay the investor? Do I get a tiny interest check after 45 days?
No, there is no periodic interest. They are issued at a discount. You might pay 98 rupees today, and in 45 days, the government hands you 100. Your return is that 2 rupee difference.
Okay, the second type is treasury bills, or T-bills.
T-bills are the standard short-term parking spot for massive institutional capital. They are issued in 3 very specific, rigid tenors: 91 days, 182 days, or 364 days. Notice that the maturity never ever exceeds 1 year. Mechanically, they operate exactly like CMBs. There is no coupon. They are issued at a discount and redeemed at full face value.
And this brings up one of the most counterintuitive tax rules in the entire book. If I buy a T-bill at a discount of 95 and the government hands me back 100 at maturity, that 5 rupee difference feels exactly like interest. I lent them money, they gave me back more money. Is it taxed as interest under other sources?
No, and this will absolutely be an exam question. The legal structure matters. You didn't receive an interest payment, you bought an asset cheap, and it matured at a higher value. The rule book explicitly states, profit arising on redemption or transfer of these bills shall be considered as a short-term capital gain.
So even though it functions economically like interest, it is legally classified as a capital gain. And because it's impossible to hold a T-bill for more than 364 days, it is mathematically impossible for it to ever become a long-term capital gain and will always be short-term taxed at your normal slab rate.
Exactly. You must classify it correctly, even if the final tax rate ends up being similar to interest. Now, let's look at the long-term sovereign debt.
The third type is dated government securities.
These are the heavyweights. They are bonds issued by the Reserve Bank of India on behalf of the central government. They carry a fixed or sometimes floating coupon rate, paid half yearly, and their tenors are massive, ranging anywhere from 5 years to 40 years. This is where pension funds park their money.
And the fourth type?
State development loans, or SDLs. These are mechanically identical to dated GSECs. They pay half-yearly interest and have long tenors. The only difference is the issuer. Instead of the central government, these are issued by individual state governments like Maharashtra or Gujarat to fund their own infrastructure projects.
How are these long-term GSECs and SDLs taxed?
The taxation perfectly mirrors the corporate bonds we just discussed. If they are listed on an exchange, you need to hold them for more than 12 months to qualify for long-term capital gains. And if you do, your profit is taxed at that flat 12.50% rate without indexation.
But the textbook outlines a massive trap regarding TDS tax deducted at source on these government bonds, Section 193.
Let's set the general rule first. The government does not want the administrative headache of deducting tiny amounts of tax from millions of retail investors holding GSECs. So the broad rule is no tax is required to be deducted under Section 193 from the payment of interest on central or state government securities for resident Indians.
It sounds too good to be true. So what is the catch?
The catch is a highly specific exception designed for 2 exact retail products. Flag this for the exam. No TDS on central or state government securities for residents, except for 2 specific bonds. The rulebook explicitly names them: the 8% savings taxable bonds 2003 and the 7.75% savings taxable bonds 2018. These were incredibly popular retail products. For these 2 specific bonds, the government will deduct TDS.
But only if you cross a certain tripwire, right?
Yes. Tax must be deducted by the payer, but only if the amount of interest paid to you during the financial year strictly exceeds rupees 10,000.
So if I have a small investment in the 7.75% 2018 bonds and I earned exactly 9,999 rupees in interest this year, the bank credits the full amount. No TDS. But the moment I earn 10,001 rupee, TDS is triggered on the entire amount.
Yes.
That exact 10,000 rupee threshold attached to those 2 specific bond years is prime multiple choice fodder for the exam.
Let's look at an institutional scenario to see how brutal the unlisted penalty is, even for government securities. Let's walk through another real-world scenario. Let's look at XYZ Bank. On January 1st, 2015, XYZ Bank invests a massive 50 lakhs into dated GSECs, the critical piece of data in this scenario. The bonds are not listed on any recognized stock exchange in India.
Oh no. Unlisted GSECs. We know exactly what the bouncer at the door is going to say.
Let's lay out the math. Face value is 100, but they bought them at a premium, an issue price of 125. They bought 40,000 bonds. The coupon rate is 7.50%, maturing in December 2027. Interest is paid half yearly. 10 years later, on January 1st, 2025, the bank transfers these bonds in a private transaction at 150 each.
Let's calculate the interest first for the financial year they sold them, 2024 to 25. The year starts April 1st. They sold on Jan 1st. That is exactly 9 months of holding during that specific financial year.
First, total annual interest. 40,000 bonds times the 100 face value is a 40 lakh face value investment. 7.50% of 40 lakhs is 3 lakhs in interest per year.
And for 9 months, it's just a proportional calculation. 3 lakhs multiplied by 9 divided by 12 gives us 2,25,000. That is the interest chargeable to tax under other sources. Now, for the massive capital gain, they bought on Jan 1st, 2015 and sold on Jan 1st, 2025. They held these government bonds for exactly 10 years.
But we remember the critical condition, not listed.
Right. Because these are unlisted GSECs, the 10-year holding period is erased from existence.
Yeah.
It falls into the always short-term trap.
Precisely. Let's calculate the damage. Full value of consideration. 40,000 bonds sold at 150 each is a massive 60 lakhs. Less cost of acquisition. 40,000 bonds bought at 125 each is 50 lakhs.
60 lakhs minus 50 lakhs leaves a raw profit of 10 lakhs. And because the bonds were unlisted, that entire 10 lakhs is a short-term capital gain. It is added to the bank's income and taxed at corporate slab rates. They locked up their capital for a decade in sovereign debt, and they are taxed as if they day traded it.
Before we leave the topic of bonds entirely, we must clarify Section 10.2.3, tax-free bonds. There is a massive public misunderstanding about this product. The rulebook states that Section 10 of the Income Tax Act provides exemptions for income earned from bonds issued by specific government-backed organizations like the National Highways Authority or NISM.
So tax-free means I don't pay tax on the interest. But if I sell the bond on the stock market for a massive profit, is that capital gain also tax-free? It says tax-free bond on the label.
Absolutely not. The label is a marketing shorthand, not a legal shield. The rulebook is explicit. However, the capital gains arising on transfer or redemption of tax-free bonds shall be chargeable to tax. The tax exemption only covers the periodic coupon payments.
Let's run a quick scenario. An investor, Mr. X, buys 5,000 tax-free bonds from the NAB. He pays 120 rupees each. They are listed on the exchange and pay a 5% tax-free coupon. 2 years later, he sells them on the market for 150 each.
The taxation is completely bifurcated. The 5% interest he earned over those 2 years is fully exempt under Section 10. His tax liability on that interest is absolute zero. But the capital gain is a different story.
Full value of consideration is 150 times 5,000 bonds, which is 7,50,000. His cost of acquisition was 120 times 5,000 bonds, which is 6 lakhs. So he has a profit of 1,50,000.
And how is that 1,50,000 taxed? Just like a normal corporate bond. Since they are listed and he held them for 2 years, which is well over the 12-month requirement, it is a long-term capital gain, and he owes a flat 12.50% tax on it. The tax-free magic does not protect your capital appreciation.
That is a crucial distinction. Okay, let's leave direct bonds behind and move to where the vast majority of retail investors actually park their money. Section 4, the mutual fund matrix. How do mutual funds fit into this?
Mutual funds pool money from millions of investors and buy a diversified portfolio of securities. But because they can buy almost anything, the tax rules have to categorize them strictly based on what is inside the portfolio. The rulebook lists 7 distinct categories. We need to detail all of them so you understand the underlying assets.
Let's run through the mutual fund menu. Number 1, equity-oriented funds.
These are the growth engines. They invest the vast majority of their pool into shares of domestic companies. They offer the highest risk, but the highest potential for long-term compounding.
Number 2, debt-oriented funds.
This is the polar opposite. These funds invest entirely in fixed income securities, the corporate bonds, and government securities we just spent an hour discussing. They're built for capital preservation and steady income, not aggressive growth.
Number 3, money market funds or liquid funds.
Think of these as a parking lot for your cash. If you have cash you might need in 2 weeks, you put it here. They only invest in highly liquid, ultra-short-term instruments like treasury bills or commercial papers. The returns are low, but the safety and liquidity are paramount.
Then we get into the hybrids. Number 4, balanced or hybrid funds.
The fund manager acts as a chef, mixing ingredients to balance risk and reward. They hold a specific proportion of volatile equity for growth and a proportion of stable debt to cushion the falls.
Number 5, gold fund or silver fund.
Exactly what it says on the tin. Instead of buying physical gold bars and paying for a safe, you buy units in a fund that holds the physical metals or related commodity instruments on your behalf.
Number 6, International Securities Fund.
If you want exposure to tech giants in the US or manufacturing in Japan, this fund takes Indian rupees, converts them, and invests purely in markets outside of India.
And finally, number 7, Fund of Funds.
This is an inception layer. Instead of researching and buying individual stocks or bonds, this mutual fund simply takes your money and buys units of other mutual funds, essentially building a portfolio of portfolios. The text also notes that any of these 7 categories can be listed and traded directly on a stock exchange as an ETF or exchange-traded fund.
Okay, so that is the menu. Now, how does the government tax the money these funds generate? There are 2 ways I can make money from a mutual fund. The fund can pay me a cash dividend, or I can sell my units for a capital gain. Let's tackle dividends first.
Historically, dividends were tax-free in the hands of the investor because the company paid a tax before distributing it. But the rules have changed. Today, dividends received by a resident are simply added to your income and taxed at your applicable slab rates. However, the exam is going to focus on the deductions you are allowed to claim against that dividend income.
Let's say I see a mutual fund paying a massive 10% dividend yield. I get greedy. I go to the bank, take out a huge personal loan at 8% interest, and dump it all into the mutual fund to capture that spread. Can I deduct the interest I am paying to the bank from the dividend income I'm receiving, since it's a direct cost of making that investment?
Yes, the law recognizes that cost. You can claim a deduction for interest expenditure incurred on money borrowed specifically to invest in those mutual funds. But DT, the government isn't stupid. They know if they let you deduct everything, wealthy investors would leverage themselves to the hilt and wipe out their entire dividend tax liability. So they put a strict cap on it.
What is the cap?
Flag this for the exam. You can deduct interest expense incurred to earn the dividend, but only up to 20% of the total dividend income. No other expenses are allowed. Not 20% of the loan interest, but 20% of the dividend earned. And furthermore, the rulebook says, no further deduction shall be allowed for any other expenses, including commission or remuneration paid to a banker or any other person to realize such dividend.
Let's run the numbers on that to see how restrictive it is. Picture this scenario. Mr. A borrows heavily and invests 50 lakhs into a mutual fund. Over the year, he receives a handsome dividend of 5 lakhs. However, to maintain that massive loan, he had to pay the bank 1,50,000 in interest.
Let's apply the rule. First, we calculate his maximum allowable deduction limit. It is 20% of the 5 lakh dividend income. 20% of 5 lakhs is exactly 1 lakh.
But wait, he actually spent 1,50,000 in real out-of-pocket interest to the bank.
The tax department does not care. Your deduction is capped at the limit. He can only claim 1 lakh. So his taxable dividend income is the 5 lakhs he received, minus the capped 1 lakh deduction. The remaining 4 lakhs is added to his total income and taxed at his slab rate. He has to eat the remaining 50,000 of interest expense entirely out of his own pocket.
What if Mr. A is a non-resident Indian?
The rules for NRIs are fundamentally different. If he is an NRI, the dividend is taxed at a flat 20% subject to any tax treaties, which we will cover soon. But crucially, the rulebook states an NRI is not allowed to deduct any expenditure from such income. The 20% interest deduction cap does not apply. The deduction is simply 0. So for an NRI, the entire gross 5 lakh dividend is immediately taxable at 20%.
Okay, dividends are straightforward. Now we reach the most complex and, frankly, the most controversial part of mutual fund taxation, capital gains. The textbook outlines a massive shift in the law. Let's call it the April 1st, 2023 divide.
It wasn't just a shift. It was an earthquake that fundamentally reshaped the Indian debt markets. A new section, Section 50AA, was introduced into the Income Tax Act.
So April 1st, 2023 is like a brick wall in the timeline. Anything bought after it in specific categories plays by entirely new rules.
Exactly. You need to visualize that wall. The rules for what happened before that date and what happened after are entirely different.
Why did the government do this? What was happening before the wall?
Before April 2023, debt mutual funds had a massive unfair tax advantage over traditional bank fixed deposits. If you put money in an FD, the interest was taxed every year at your highest slab rate, say 30%. But if you put that same money into a debt mutual fund and held it for 3 years, it was treated as a long-term capital gain. You got a lower tax rate, A&D, you got indexation benefits, which wiped out a huge chunk of your tax liability due to inflation. Wealthy investors were abandoning banks and using debt funds as a tax dodge.
So the government dropped the hammer.
Yes. And that hammer is Section 50AA. To understand who gets hit, the text categorizes mutual funds into specific types based on what's inside their portfolio. Let's look at the target of this new law, the Specified Mutual Fund, or SMF.
Okay, so what makes a fund a specified mutual fund?
The law defines two types of funds that fall into this crosshair. Type 1 is a mutual fund that invests 65% or more of its proceeds directly or indirectly into debt or money market instruments. So your classic, pure debt fund.
Okay, and what is the crucial condition?
It only becomes a specified mutual fund if you bought the units on or after April 1st, 2023. If you bought them before, you are safe behind the wall.
What is the Type 2 specified mutual fund?
Type 2 is essentially a catch-all for funds trying to be clever. It defines an SMF as any debt-oriented hybrid gold-silver international or fund of funds that invests less than 35% of its proceeds into the equity shares of domestic Indian companies, and again is bought after the April 1st deadline.
So if a fund manager creates a hybrid fund and they put 34% in domestic equity and 66% in international stocks or gold, it fails the 35% test. It gets lumped into the specified mutual fund category.
Right.
So what exactly happens if a fund is labeled an SMF? What does Section 50AA actually do?
Flag this for the exam. For these SMFs bought on or after April 1st, 2023, Section 50AA mandates they are always taxed as short-term capital gains, regardless of how long you hold them.
That is devastating. It's the exact same punishment they gave to unlisted bonds. If I buy a pure debt mutual fund today, and I responsibly hold it for 20 years to build a retirement corpus, when I finally cash it out, the entire 20 years of accumulated compounding is treated as a short-term gain. It's added to my income that year and taxed at my highest slab rate.
Exactly. There is absolutely no long-term capital gain benefit. The 12.50% concessional rate is gone. Indexation is gone. By doing this, the government essentially made debt mutual funds mathematically identical to a bank fixed deposit from a tax perspective. The arbitrage is dead.
Okay, but what about the funds that escape the 50AA net? The rulebook refers to them as other mutual funds.
These are the survivors. This category covers two things. First, any debt fund that you acquired on or before March 31st, 2023. The government grandfathered these in. They get to play by the old rules. Second, it covers new funds bought after April 1st, 2023 that manage to thread the needle. They aren't pure equity funds, but they manage to hold exactly between 35% and 65% domestic equity.
For these surviving other mutual funds, how do the holding periods work to get long-term status?
It depends on listing status, but the numbers are different from direct bonds. If the mutual fund units are listed on an exchange like an ETF, the holding period to qualify as long-term is 12 months. But if the units are unlisted, which the vast majority of standard mutual fund units are, the required holding period is 24 months.
Wait, pause. Let me check my notes. For direct corporate bonds, we learned that unlisted meant never long-term. Unlisted bonds were permanently short-term. But for these specific unlisted mutual funds, you were saying 24 months is the magic threshold to unlock long-term status.
That is a brilliant catch, and it is exactly where candidates fail the exam. You must decouple bonds from mutual funds in your head. Unlisted direct bond equals always short-term. Unlisted grandfathered mutual fund equals 24 months to become long-term. Do not mix them up. Once an unlisted mutual fund hits that 24-month mark, the gain is taxed at the highly beneficial 12.50% rate.
Let's walk through a scenario to prove how powerful that April 1st deadline is. Let's say we have an investor, Mr. A. He decides to invest in a standard unlisted debt-oriented mutual fund. He buys 1,000 units at 150 rupees per unit. His purchase date is January 1st, 2017. He holds them for a long time and finally redeems them on March 15th, 2025 for 300 rupees per unit.
The first thing you should look at is the purchase date, Jan 1st, 2017. That is well before the April 1st, 2023 cutoff. Therefore, Section 50A does not apply to this investment. He is safely grandfathered under the old rules.
Correct. Now, check his holding period. From Jan 2017 to March 2025 is over 8 years. Since it's an unlisted mutual fund that isn't hit by 50AA, he needs to cross the 24-month threshold. 8 years is way past 24 months. So this is definitively a long-term capital gain.
Let's do the math. Full value of consideration is 1,000 units times 300, which is 3 lakhs, less cost of acquisition, 1,000 units times his purchase price of 150, which is 1,50,000. So he has a long-term capital gain of 1,50,000.
And because he escaped 50 AA, how's it taxed? At the highly beneficial flat rate of 12.50%, a phenomenal result for an 8-year hold.
But let's run the counterfactual. What if he bought that exact same fund at the exact same price, but his purchase date was April 2nd, 2023?
Everything changes. April 2nd is after the wall. Section 50 AA activates. His debt mutual fund is now legally a specified mutual fund. The holding period becomes instantly irrelevant. When he sells, that 1,50,000 profit is classified as a short-term capital gain. It is added to his salary and taxed at up to 30%. That single date on the calendar cuts his after-tax returns by more than half.
That is incredible. Okay, we have thoroughly mapped the domestic landscape. Let's move to Section 5. Taxation of non-residents crossing borders. This is where things get philosophically complicated.
Because of the nightmare of being taxed twice, right? The double taxation dilemma.
Exactly. You have two different sovereign nations trying to tax the exact same pool of money. Imagine you are an NRI living in the United States. You invest in Indian corporate debentures and earn 10 lakhs in interest. The Indian government says you earned that money on our soil. We are taxing it at our slab rates. The U.S. government looks at your global income and says you are a U.S. resident. We are taxing that interest too.
If both countries take 30%, you are left with almost nothing. How does an investor survive that?
They survive through DTAA's double taxation avoidance agreements. These are bilateral treaties signed between India and dozens of countries around the world. The treaty acts as a referee. The golden rule for the taxpayer is this. Where a non-resident is eligible for DTAA benefits, they will be taxed at the rate mentioned in the relevant DTAA treaty, or the standard rate in the Indian Income Tax Act, whichever is lower and more beneficial to them.
So you essentially get to hold the Indian rulebook in one hand, the treaty in the other, and pick whichever number is smaller.
Exactly. Let's look at the textbook's example. Under the specific India-USA DTA, the maximum tax rate India is allowed to charge a U.S. resident on interest income is capped at 15%. So instead of paying the high Indian slab rates, the U.S. resident points to the treaty and only pays 15% to India. And then when they file their taxes in the U.S., they can claim a tax credit for the 15% they already paid to India, so they aren't taxed twice on the same dollars.
But the Indian government isn't just going to take your word for it, right? You can't just check a box online and say, trust me, I live in London.
Absolutely not. The compliance requirements are incredibly strict. To claim any relief under a DTAA, the non-resident must obtain a tax residency certificate, or TRC. This is a formal, stamped document from the government of their home country, like the IRS in the U.S., proving they are a legitimate tax resident there.
And what else?
In addition to the TRC from their home country, they must also file Form 10F with the Indian tax authorities. This is a self-declaration providing prescribed details about their status. The paperwork is non-negotiable.
The rulebook then shifts to some highly specific, ring-fenced provisions under Chapter 12A. Who is this for?
This is a specialized tax regime built specifically for non-resident Indians or persons of Indian origin PIOs. The rulebook defines a PIO as an individual who, or either of whose parents or grandparents, was born in undivided India. To use these special rules, the absolute core requirement is that your investments in India must be made using convertible foreign exchange.
Okay, if I bring in foreign currency, can I just invest in anything and get these special tax rates? Can I dump it into a private tech startup?
No. The eligible investments are strictly walled off. You can buy shares in an Indian company. You can buy debentures or deposits in an Indian company, BUT, and this is a huge exam trap. It must not be a private company under the Companies Act. It has to be a public company. And finally, you can buy certain notified government securities.
So no private equity or venture capital. What are the actual tax rates if I stick to this approved menu?
It is a mixed bag. First, the restrictions. If you use Chapter 12A, you are explicitly denied any indexation benefits on long-term capital gains. Your profit is your raw profit. Second, the rates. Tax on the periodic investment income, the interest or dividends, is capped at a flat 20%. And if you sell the asset for a long-term capital gain, that gain is taxed at 12.50%.
But there is a massive exemption rule built into this chapter regarding reinvestment. How does that loop work?
This is the government trying to lock your capital inside the country. Let's say our NRI sells those public company debentures for a massive long-term capital gain. Normally, they owe 12.50% tax. But if they take the net consideration, the total money they received from the sale, and reinvest it into another approved Chapter 12 asset within 6 months, the entire capital gains tax on the original sale is wiped out. It is completely exempt.
What if they need some cash to buy a car back home? What if they only reinvest half of the money?
It's a mathematical ratio. If only a part of the net consideration is reinvested, then a proportionate amount of the long-term capital gain is exempted. But there is a massive catch. If you use this exemption to avoid the tax, you must hold the new second asset for at least 3 years. If you get impatient and sell the newly purchased asset within 3 years, the capital gains that were exempted earlier are immediately revoked. They come back from the dead and are taxed in the year you broke the rule.
Wow, so it's a lock-in. There is one final paragraph in the non-resident section that looks incredibly niche regarding overseas retirement funds. Section 89A. The text mentions it was brought in to fix a mismatch. What was the actual problem here?
It was a timing nightmare that was destroying the retirement plans of NRIs returning to India. Imagine you work in the U.S. for 20 years. You build up a massive 401k retirement account. You move back to India to retire. The U.S. government operates on a receipt basis for retirement funds. They don't tax you while the money is growing inside the account. They only tax you years later when you finally withdraw cash to live on.
That makes sense. That's how retirement accounts should work.
But India taxes global income on an accrual basis. So the Indian tax authorities were looking at your U.S. 401k, seeing the stocks inside it go up in value every year, and demanding you pay Indian tax on those unrealized gains immediately. You were being forced to pay Indian tax out of pocket on money locked in a U.S. account that you couldn't even touch without paying massive early withdrawal penalties in America.
That is horrific. So Section 89A was the patch.
Yes. Section 89A was introduced to synchronize the clocks. It dictates that income from specified retirement accounts in notified countries will only be taxed in India at the time of actual withdrawal or redemption. This forces the Indian tax clock to match the foreign tax clock, allowing the investor to properly claim their treaty credits.
And what are the notified countries? I assume it's everywhere.
Flag this for the exam. Section 89A specifically names 3 countries, the USA, Canada, and the United Kingdom. If a multiple-choice question asks you about a returning NRI's retirement fund from Australia or Singapore, Section 89A does not apply based on the current text. You have to know those 3 specific flags.
USA, Canada, UK. Got it. All right, we are in the home stretch. Section 6, market-linked debentures, the hybrid beast. We spent a lot of time on standard fixed coupon bonds. How is a market-linked debenture, or MLD, fundamentally different?
With a traditional bond, certainty is the point. You know exactly what your coupon is. An MLD throws certainty out the window. Their returns are not fixed. Instead, the final payout is mathematically linked to the performance of an underlying market index like the Nifty 50 or a specific security. The movement of that completely separate underlying asset dictates how much money you make.
That sounds like a derivative masquerading as a bond. The rulebook splits them into 2 types, principal protected and principal non-protected.
It's about setting a floor on your losses. A principal-protected MLD guarantees that, no matter how terribly the underlying index crashes, the issuer will at least hand you back your original initial investment at maturity. A non-protected MLD removes the floor. If the index crashes, your principal crashes with it.
The rulebook outlines 3 highly specific features of MLDs. We have to detail all 3. Feature A, computation of coupon rate.
We touched on this. The return is variable. It is a formula based on a scenario. For example, if the Nifty 50 index rises by more than 15%, you get a 10% return. If it rises by less than 15%, you get a 5% return.
Feature B, issuers and investors. Who is actually buying and selling these things? Because I don't see them on my retail brokerage app.
You don't see them because they are not for retail investors. The regulations mandate that issuers must be substantial entities with a minimum net worth of Rs 100 crores. On the flip side, the investors are almost exclusively high net worth individuals, HNIs. These are highly bespoke, complex wealth management products.
Feature C, tenure and repayment. How long is my money locked up?
The tenure is generally midterm, anywhere between 12 to 36 months. But the crucial distinction is repayment. Unlike a traditional corporate bond that drips out half-yearly interest payments, an MLD is silent. It offers absolutely no periodic interest. The entire return your principal, plus whatever complex index-linked interest you earned, is paid out in one massive lump sum strictly upon maturity.
Okay, so we have a complex product built for the ultra-wealthy that pays out in a lump sum. Now for the tax hammer. Section 10.5.1 details the tax on income from MLDs. And look what monster has returned from the mutual fund section. Section 50AA.
Yes. Before the Finance Act 2023, MLDs were the ultimate tax dodge for the rich. Wealthy investors were using them to get equity-like, index-linked returns, but because MLDs were technically classified as listed debentures, they were paying the tiny 12.5% long-term capital gains tax on those massive profits if they held them for just over a year. The government realized they were bleeding tax revenue, so they unleashed Section 50AA.
But wait, when we discussed 50AA for specified mutual funds, there was a grandfathering clause. It only applied if you bought the fund after the April 1st, 2023 wall. How does 50AA apply to MLDs?
Flag this for the exam. Regardless of when MLDs were bought, even before April 1st, 2023, if transferred or redeemed on or after April 1st, 2023, they fall under Section 50AA.
So just like the specified mutual funds, there is no long-term capital gain for MLDs anymore. It's always short-term.
Exactly. There is absolutely no grandfathering. If the maturity date fell after April 1st, 2023, the trap springs shut. The law is absolute.
And we know exactly what 50AA does. The capital gains are taxable strictly as short-term capital gains, irrespective of the period of holding.
Yes. Just like unlisted corporate bonds. Section 10.6 drives the final nail into the coffin by explicitly listing the benefits that are forbidden under 50AA. Number 1, no benefit of period of holding. The clock doesn't matter, it's always short-term. Number 2, no deduction for the cost of improvement.
What does that mean in this context?
In complex financial structures, there are rare scenarios where an investor might incur a capital expense to alter or improve the terms of a security. The law completely shuts this down for MLDs and specified mutual funds. It explicitly dictates that the cost of improvement shall be taken to be NIL, regardless of whether you or a previous owner paid for it.
So the calculation for an MLD is stripped down to the bone. You take the final lump sum you receive at maturity, you subtract the original cash you handed over to buy it, you subtract any direct transfer expenses, and that raw profit is hit with your maximum short-term tax rate.
That is it. The era of tax-efficient, complex MLD structures for wealth management is definitively over.
Which brings us to the outro. Section 10.7 in the materials is just one massive, intimidating summary table. I need a way to mentally organize all these rules before the exam. How do we synthesize this chaos?
You need to mentally divide the financial world into two groups, Group A and Group B. Let's call Group A the good guys.
Who are the good guys?
The good guys are the instruments the government wants you to invest in because they are transparent and stable. This includes listed corporate bonds, dated government securities, state development loans, listed municipal debt, and sovereign gold bonds. For every single one of these good guys, the threshold to reach the promised land of long-term capital gains is a quick 12 months. Hold them for a year and a day, and your reward is a flat 12.50% tax rate.
What about the surviving mutual funds, the ones that escaped 50AA?
They are in Group A, but with a slight speed bump. If they're listed ETFs, they get the 12-month rule. If they are unlisted, which most are, they have to wait 24 months to get that 12.50% rate. But they still get there.
Okay, what is Group B?
Group B are the bad boys of the tax code. These are the instruments the government is actively trying to discourage retail investors from using, either because they are opaque, too complex, or historically used for tax arbitrage. This includes unlisted corporate bonds, market-linked debentures, and specified mutual funds bought after April 1st, 2023.
And what is the punishment for the bad boys?
The holding period to achieve long-term status is not applicable. It does not exist. You can hold them for a century, and they will always generate short-term capital gains, and they will always be taxed at your highest normal slab rate.
And then there are the two oddballs that don't fit the good guy, bad guy narrative. Treasury bills and cash management bills.
Right. They are government-backed, but they are pure short-term parking instruments. Remember the golden rule for them. They don't pay interest. The difference between the discount you buy them at and the face value they redeem at is legally classified as a short-term capital gain.
This has been an incredibly dense hour, but mapping it out conceptually, like this understanding why the rules exist, is the only way to actually beat the exam. Memorizing the table won't work. You have to understand the logic.
Right.
Thank you for translating all of this regulatory jargon into actual English.
My pleasure.
Before we wrap up, I want to leave you, the listener, with a final retrospective thought to chew on. We have spent an hour dissecting exactly how the government taxes debt products. But think about the broader implications of what we just learned, specifically regarding Section 50AA and the unlisted bond rules.
It's massive.
Right. By aggressively reaching into the market and removing long-term tax benefits from unlisted bonds, from MLDs, and from pure debt mutual funds, the government isn't just trying to balance a budget or collect a little more revenue. They're using the tax code as a massive instrument of behavioral engineering. They are actively punishing opacity. They are forcing institutional capital out of the shadows and into the listed transparent markets where it can be monitored. And for regular retail investors, they are essentially saying, we are dismantling the complex debt structures that mimic equity returns. If you want safety, go to a bank FD. If you want tax-efficient compounding, go buy actual equity. It makes you wonder, with the traditional tax arbitrage structures permanently destroyed, how will the Indian debt markets innovate next to attract capital? Or is the era of complex debt engineering for the retail investor permanently closed? Keep that in mind as you review your notes. The tax code isn't just a math problem. It's the blueprint for the entire financial market. Good luck on the exam.